Welcome to Finance in 15, where we share a perspective on the markets and investing. Our goal is to help separate the data from the narrative, providing clear insights into what's really driving markets and what it means for your portfolio. Joined today, we have Josh and Melissa Stein. Thank you both for being here today.
Thanks, Stephen.
So after a strong rally in 2025, markets experienced more volatility in early 2026. As of early March, the S&P 500 is down roughly 1.5% year to date. The index recently traded near 6,700, below an all-time high reached earlier this year. Kind of toggling gears a bit, talking about current conditions in the economy, recent economic data suggests resilient economic data heading into the first quarter. February employment remained solid, with notable job gains in healthcare, education, and construction. However, consumer demand continues to be a key driver for economic activity, though overall growth has moderated from stronger pace seen in earlier quarters. With that all being said, there are some geopolitical risks. I'm gonna let Josh kind of talk through some of those, especially with the escalating conflict with Iran.
Sure, thanks, Stephen. So these last few weeks in particular have shown why it's very important to make sure that we always are carefully considering geopolitical risk. It's kind of one of those things that it goes away for a potential extended period of time, and then all of a sudden, boom, we're hit with that risk again. And it kind of is a little bit likened to the Russia Ukraine conflict that we had a few years ago that certainly added some additional stresses to the market on top of inflationary concerns. And geopolitical risk is kind of one of those things where we certainly want to always make sure that it's on our radar. And by having well-diversified portfolios and a good volatility measure within the portfolio, and maybe even some opportunistic investing to try to take advantage of some of the maybe opportunities within that area, we try to make sure that we're always kind of considering these types of things. And Melissa can kind of even elaborate a little bit more on that as far as how geopolitical risk relates overall to the broader markets over time. Because what we've kind of found is it's not necessarily as impactful as people think it is, in particular in the short term, but absolutely something that we've spent a lot of time over the last few weeks really trying to identify how we want to make adjustments. And overall, our portfolio, even prior to these risks, have had some very defensive positioning in nature already embedded into that, which is certainly providing useful right now.
Right, and I think what Josh is trying to say, like to sort of sum that up a little bit, is if you have a very well-constructed, thoughtfully managed and active portfolio management, then these things, they do matter, but our portfolio should be able to weather that storm. And actually, I mean, the good news about this situation is, if you look at all the data since 1900 and equity performance, even in times of volatility and geopolitical stress, it actually shows little to no correlation to that geopolitical stress over the long run. Now, in extreme situations where this would erupt into like a world war or something like that, that's a little bit of a different discussion, because those things could have a significant economic impact. Hopefully, we're not going down that road. But economic risks and some of the things that Stephen was talking about earlier, those have a much greater impact on the portfolio. So we tend to focus on the things, and we're gonna focus on the things that we can control the most and that are understood and that we can control in the portfolio and make sure that we're minimizing risk. So I mean, it's not good news what's happening, but the good news is that hopefully it will be short term, and this is gonna be another blip on the radar screen.
I think a good way to summarize it is, assuming geopolitical risk stays just that, being geopolitical and not necessarily economic, they tend to be short term. And I know it sounds like kind of really evil to say, but the whole concept of buy the invasion really does actually show some economic realities to it, which is markets certainly react, and they react negatively to uncertainty. But there can be possibly buying opportunities as some overselling happens during the initial onset of geopolitical conflict. And really, unless we get to the point where it spirals into a true recession, they tend to be reasonably benign. Of course, we don't have a crystal ball, and of course, certainly there's a very emotional piece to war in general. We're not being unsensitive to that. and we don't know what the future holds. But within the vacuum of the geopolitical side, our reaction to that tends to be a little bit less impactful than looking at the overall economic risk.
Right.
So let's talk about that, because I think sometimes we tend to focus so much on the geopolitical side that we oversimplify maybe how the economy really is doing. So we have inflation that is obviously not at Fed targets, but is reasonably consistent and expected to continue to come down. We have future interest rate decreases on the horizon. Of course, there's a lot that could happen between now and when they cut rates next, but most economists are slating in 1 to 2 rate cuts this year, which certainly helps the housing industry, helps business. Right?
Well, we've already seen a little bit of pickup in the housing industry from the drop in rates. It's already happened.
Yep.
There's been a little bit more volatility, but overall we're seeing a lot of supportive evidence that, equities could continue to do well. Earnings have done well.
Yep.
I think last quarter, what was it, up 14?
Yeah, I mean, earnings are still being heavily driven by the AI innovation. And although we're not going to drive too much of this conversation around AI in general, needless to say, it is still a major economic benefit to the stock market per se right now, fueling good Q4 earnings on a corporate level. And then we kind of have this extra backstop here with the stimulus from the big beautiful bill.
Whether you like it or not, there have been some stimulative effects from that. And so
it's making headway for continued potential GDP growth. Is that going to be significant? Maybe not, but I think most economists are kind of leaning heavily towards a positive growth year in the US, probably somewhere in the low 2s, which is somewhat indicative of a kind of normal growth year in the US for what's going on right now, meaning it's likely that unless we see significant increase in this geopolitical conflict, that it remains potentially just that from an economic perspective, and we don't potentially enter a recession.
Yeah. So we're certainly not discounting the impact of geopolitical events or things that are happening, but it's just sort of one piece of the puzzle, that fits into the decisions and rebalancing the portfolios. And the reality is that, we have to look at things from different angles. And we're going to talk a little bit about some of our take and the changes we've been making in the portfolio, hopefully helping to give you an understanding of like where our convictions are and where we think things are at. I mean, certainly I think we're cautiously optimistic. We are defensive, I think, overall. Not that we don't think there is some room, for equities to move, but we want to be, aware of what's going on, but also kind of separate out some of the noise. And there's just a lot in the news right now, and I know this is what people are focused on, but we don't think at this moment it's going to derail client goals. Like I had a client email me this morning, and they said, "Hey, we're heading out." They were thinking about buying a property a while ago, and they said, "Hey, we're heading out. We're actually looking at some properties. Melissa, should I not do this?" And I said, well, no, I don't think the plan has changed overall. Nothing's changed in their financial plan to derail that goal for them, and even making a withdrawal from the portfolio or purchasing this property. And I think that's the important part, is that clients want to know is like, what does this mean for me today? And I think today, at this moment, it doesn't mean anything. It means that we're managing the portfolio.
You need to be aware.
Yes, exactly. So I think with that being said, I think I'd like us to talk a little bit about some of the convictions we have around our portfolio changes and what that actually means for our clients and some of the reasoning behind that. Josh, do you want to kind of dive into that?
Sure. So the larger themes we've had in our most current portfolio rebalance was repositioning some of the larger asset classes, in particular our large cap positioning. In general, we've had a pretty heavy tilt towards what we call quality. And although we still feel it's important to own some quality companies, we've redistributed some of those positions to some smaller and middle-sized companies, as well as a very small percentage more towards international. These are asset classes that we've been relatively underweight on over time, and we're just kind of slowly bringing those back up closer to target. It's part of the whole broadening theme. In prior quarters, we've been more concentrated towards some of the larger growth positions that's been a good place to be. Although with added volatility and coming off some pretty good years in the markets, we feel highly convicted that there's going to be a more broader based possibility for returns than really heavily concentrated within some of the Mag 7 and within some of the tech companies.
Yeah.
So part of the positioning that we've been doing is trying to spread some of those out. We've also been continuing to incorporate some unique sector positions into our portfolio. As I mentioned before, like something like geopolitical risk, doesn't mean you have to be completely defensive, but there can be some opportunities for some tactical and timely adjustments to the portfolio because of geopolitical risks. And so some of those sector positions we've continued to add into the portfolio. Steve, you want to maybe hit on a few of those?
Yeah, absolutely. So, previously we've owned the aerospace and defense ETF in our growth models. However, since we are looking at this as more of an opportunistic play, adding the aerospace and defense in the conservative portfolios, we had made that tweak, this quarter. And with that, and the one big beautiful bill with the increase of spending, and especially next 4 years, we look at this as, there's still demand for defense-related companies. So with that being said, having a small sector play in the portfolio was something that we thought as an investment committee was something that our clients would benefit from.
Yeah, so this is actually one that we were invested in even before there was this most recent geopolitical conflict. As you mentioned, it's not just war that can potentially cause more profitability in the defense sector, but just what the government is going into anyways. And so, as you said, it's being reinforced by some of the conflict that we're seeing now, but this is something that we've kind of been convicted on as a good place to have a small allocation, and even prior to some of the Iran conflict.
And then some updates on our growth-oriented portfolios. We did add a small allocation to gold. So previously we only had that in our more conservative models. However, gold can serve as two purposes. First one being a defensive hedge against geopolitical uncertainty, which we're certainly seeing today. But also it could be owned for some growth opportunities. So again, a small position in gold in our growth portfolios. So those are some additions on the growth models.
And our objective is to make timely and tactical adjustments. It's uncommon that we have something so extreme, even in an uncertain situation like the conflict with Iran, that we're going to be making massively tactical moves on one way or another. That being said, it's important to us to ensure that we do our best job to kind of weigh what opportunities are there, and then what commensurate risks come with that, and then make those adjustments to try to keep those in place. And obviously current political and current economic conditions will dictate some of that. And so those are just some of the broader themes that we've incorporated into the portfolios this quarter.
Well, in general too, if you guys want to comment a little bit more on sort of unraveling some of those like larger growth, like AI companies, where there's been this sort of concentrated return coming from just a few stocks. I mean, from my understanding, I think the S&P 500 is more concentrated than it has been since 2000, 2001. And I mean, that in itself is a little bit, I guess like raises some alarm bells. What are your thoughts on that? Because I know we made some big changes of some positions to enhance that, which you had already mentioned too.
Yeah, it's one of those things where if you're not very meticulous, you can find yourself very heavily concentrated in the same companies. Whether you're picking any individual U.S. growth fund, you're likely going to trip over the Mag 7. And if you're trying to get even more fancy and maybe have some specific sector plays or some factor plays in there, you could even be even more heavily concentrated in those positions without even necessarily realizing it, just because of how large those companies are relative to every other company. But that doesn't mean that there aren't good growth opportunities. And with some of the economic headwinds, with some of the political headwinds, and even with just the fact that there are plenty of other companies that are profitable and making money besides the Mag 7, it's easy to lose exposure to the rest of the 490 companies in the S&P 500, let alone the other 2,000 in the Russell 2000. So part of our objective has really just been to be very meticulous about how we continue to maintain exposure outside of the Mag 7 per se. That being said, we still are heavily convicted that AI is an important place to be. We don't want to lose sight of that. And timing, whether or not we want to own it or not own it, is not a winning proposition. So we still have good quality exposure. but we don't want to be overexposed and not be aware of that. And that's one thing that we feel we'd rather be at least at benchmark, if not maybe even slightly below in some of those areas right now, because there's other places that we feel maybe in the next few quarters are more important. So that's been part of that theme.
Well, and that's one of those typical, I think, investor pitfalls where we get really excited about something that's doing really well. We want to invest more in it, but oftentimes that's like the worst time to do it. And we just want to make sure that, historically, when we look at a high concentration in just a few stocks, that we're broadening that out, and making sure we're getting exposure to those other areas, because they might be able to get similar returns, but with probably less risk. I mean, we don't know. We don't have a crystal ball, but like historically, that's what it looks like. And we try not to get caught up in sort of like some of those emotional trends. And that's part of, our value is trying to take, once again, separating the data from the narrative, separating the noise, from what really matters. And, those are the things that really matter.
One other large piece that's probably worth spending a moment to mention, and we've talked about this in other Finance at 15 meetings, is as these things continue to play out economically, in particular on the growth side, on the AI side, on the technology side, we find this massive weight of what we call correlation, which is basically investments moving together at the same speed or at the same pace, regardless of if there's any true impact. So if investment A goes up, investment B goes up. If investment A goes down, investment B goes down, even though they may not be related at all. And correlation is a really hard thing to combat when you want to manage risk, because you could feel very well diversified because you own a lot of different things. But if they all move together at the same time, your diversification actually is heavily diminished. So we've added a lot of layers into our investment portfolio to really help spread apart some of that correlation. Do you want to maybe, Stephen, bring up a few of those individual areas as to kind of what we're doing and why in those areas as it relates to helping manage that correlation issue?
So yeah, we continue to hold that buffer ETF position in our conservative models. So, as a reminder, if the broader market like the S&P 500 were to go down 15%, in theory, this is supposed to buffer out that first 10% of risk. So it really does try to limit that volatility for, those collecting income and, maybe in the distribution phase of life. So we still own that in the portfolio to kind of manage some of that volatility. And then we also own a market neutral position in the conservative portfolios as well. This is supposed to provide non-correlation to the broader markets, as kind of Josh alluded to. And then also gold is kind of another alternative that can help provide us some non-correlating asset classes.
And the importance of these positions are helping maintain some true level of diversification, even when things start to move in tandem.
And we've talked about this a lot over the years and just how our asset allocation has evolved. And the reality is we can't just diversify stock risk with bonds anymore. I mean, we can, but we choose to utilize other tools that we have found really has enhanced our risk management. And I think that sort of leads me down another road, which is we can talk about this until the cows come home, but none of us at this table actually really know what's going to happen, over the next several months, over the next year in the markets. I mean, we can do our best to project. One of the things we do with our clients is we work with them on their financial planning and their goal projection so that when things like this come up, okay, we've already accounted for good markets and bad markets in analyzing their financial projections. So there's nobody who's retired at our firm that doesn't have a projection that shows some good years and some bad years. We know that those things are inevitable. They're going to happen. But we design their financial planning strategies, their cash flow projections, their tax projections, all of their retirement planning projections to include the ups and the downs. So I think, we can speculate a lot about whether it's going to go up, whether it's going to go down. But what we know is that our clients have a higher probability of success because we've built their plan to include both up and down markets. And we know those are going to happen. I mean, we can't prevent them from happening. We can reduce and diminish the impact to our clients' goals. And that is what we do through diversification, through professional management, through active management. But I guess the good news for our clients is these things on a year-to-year basis, they shouldn't matter when it comes to, the long-term plan. And if it does, our clients are going to know because we're going to review with them their goals and we're going to talk about, hey, these things have happened. This is how we maybe need to rethink things. So, this stuff is really important. but also, helping clients understand how it fits into their overall goals is also important.
Even though there's a lot of economic information to show that we may not enter a recession in particular because of the Iran war, it doesn't mean that there won't ever be another recession, and it's somewhat inevitable.
I mean, it is inevitable. And market correction, there's always market corrections.
Right.
That's the norm, right?
It is, and looking at some data, if you go back since 1942, the S&P 500 has declined 5% 3 times a year on average, and 10% every 16 months. So almost every year that we see a 10% decline, and we see bear markets of 20% or more roughly every 5 years or so. So these are things that, although they may not happen this year, they're going to happen most likely.
We know they're going to happen
sometime in your continued investing career, if not time over time. And although they can feel dramatic in the moment, and of course nobody likes seeing their portfolio down for a quarter or two, we already take those things into consideration when it comes to your goals. And if you can't get to a goal because of a recession, then we need to be doing work with our clients well ahead of that recession to ensure that they can weather those storms, because they're going to come. And we've been in one of the longest bull market runs in modern economics. So to some degree, it's only a matter of time.
Yeah, I mean, we haven't had a normal recession in a long time.
Right.
But here's the thing, what you do when it happens is actually what matters.
Right.
And sometimes being prepared for that and then doing nothing is the best thing to do. And I guess that's the point, is when you do financial planning and you do it in tandem with a great investment strategy, then you get the result of having a high probability of success because you can weather those storms.
Exactly.
So in closing today, I just want to thank Josh and Steven for their commentary today. Thank you for tuning in. We really appreciate the time. We're always here to answer questions for our clients. Some key takeaways today, just to kind of recap a little bit, is geopolitical risk is a concern, but it's not the main driver in our portfolios. We're focused on more of the economic risk factors, which actually, oddly enough, seem to look like things are kind of hopping along and going pretty well there. So, I wouldn't say we're overly optimistic, but maybe cautiously optimistic is a better way of putting it. Also just in a more accommodating environment moving forward. So hopefully, some of these geopolitical risks will dissipate, stay contained. We can kind of move on as business as usual, but if not, we have also built a lot of risk management into the portfolios and kind of staying defensive in nature and invested in really high quality things. And we're always here for our clients from a financial planning perspective. Also, just should not forget to note that it's tax season, and if anyone has any specific questions about their taxes, or is thinking about, hey, I still haven't made my Roth contribution, or I want to make a separate simple contribution, you have till April 15th to do that. Look for some more correspondence from us on that, both before April 15th and after April 15th. But other than that, thanks for tuning in. Please like or subscribe to our YouTube channel so that more people can hopefully hear our good information. And if there's anything you want to hear about in particular, please don't hesitate to let us know. Thanks again and have a great day.